So we did it for her, and then after she, halfway through, I noticed she wasn't even there anymore. So, and she hadn't called or said anything since. Okay. Let's roll.
Chapter 11.
Chapter 11. We're going into partnerships now.
Oh, we're still there? I thought we were on corporation though.
Oh, I'm sorry, we are on corporations. We just finished partnerships. Okay. Corporations are a little different than the other animals that we've been dealing with. Okay. They got the most rigid laws. A corporation has what's called, you got double taxation. The corporation pays tax, where an S corp and a partnership, they pass their taxes on through the 1040. Schedule C, they do theirs on a 1040, but a corporation, it's its own entity. And like Mitt Romney said, a corporation is a person too. He got a lot of flack for that because they're not really people. They don't have hearts or souls, especially the big ones. Okay, so to have a corporation, you're going to have to file for a corporation. You have to choose. You can, when you start the entity, you can become a corporation right then, or you can start off and be a sole proprietorship, a partnership, okay, and then switch to a corporation. To become an S corporation, which we'll probably get to next week, you have to become a corporation, and then you could immediately choose to be an S corporation, which is the type of corporation. The normal corporation is called a C corporation. They're under the section C, under the code, and the S corporation is under section S. That's how they got their names. And so later on, that we're going to know that a C corporation is done on 1120, and an S corporation is done on 1120S. Okay, these are basics. So there's a little bit you can read. So a corporation files a charter, prepares bylaws, is overseen by a board of directors, and it issues stock. This is all on page 273. Mostly just read this about form after 997. You're not going to really get much about that. Okay, going to the eligibility, may elect to be a classification. Okay, to become a corporation, you have to file Form 8832. Everybody good with that? That's the, you want to get an entity classification, you want to be a corporation. You got to have the date of the election. It cannot be more than 75 days before, so you can't say, or 12 months after the date the election was filed. So you got to have it in between those. In reality, they give you a lot of leeway if you, oh, I forgot, kind of thing. Especially and with S corps, they will go ahead, and even though you actually didn't get the corporation till March, they'll let you backdate it to January 1st. They're not going to make, well, what were you before you were a corporation? And they're not going to make you be a partnership for too much, generally speaking. Okay, if you make an election to change its classifications, the corporation cannot change its classifications for 60 months, 5 years. So, or without, you can do that, I believe, with permission of the IRS, but you'd have to ask. Okay, there is an exception. You may allow a corporation to change its classification by private letter ruling, that's by asking the IRS, or if more than 50% of the ownership interest are owned by different people that made the prior election. you know, you got a new batch of people that own it.
Excuse me.
There's a list here of people, all different kinds of people that are automatically made as corporations, insurance companies, certain banks, wholly owned state and local governments. They don't usually ask that much, but that would be an easy question because it's always going to be insurance companies and banks. So they're going to put something on there, you know, that looks out of the ordinary. Certain foreign businesses got to be a corporation. Certain publicly traded partnerships. Again, you're not going to see many. There might be one question. All of these are corporations except, and they'll, you know. A single member LLC, a limited liability company, it starts off what? It's always a sole proprietorship. It's an LLC, it's a disregarded entity, but you can choose to make it into a corporation. But you have to choose, you have to elect. I think that's the word they want you to say, is elect. Okay, non-exempt, closely held corporation is classified as a personal holding company if a significant number of its income is passive in nature. What would that mean for you? If they had a company that was just a couple of guys owned it, but all the income it was made from was passive in nature.
Real estate management?
Yeah, something like that maybe. I'm not sure about interest and dividends and stocks. We aren't going to go into that. They're not going to have any questions about that. Personal service corporation, what would that be? An accounting firm. An accounting firm could be a corporation or an engineering firm or doctors, lawyers, dentists. Personal service. They make their money by the guy that runs the company giving you a personal service. Your local CPA firm is a good one. Your local engineering firm, you know, where you got a doctor, that would be a good one. They used to pay taxes at 35%, and then they'd have to pay on their dividends. Now, all the income from your corporations are going to be taxed at 21%. We'll get into that in a minute, but it's for corporations, it's now become a good deal. Now, their capital gains are taxed at 21%. Of course, that's more than normal capital gains that we would pay.
Who's we?
We being individuals. Which normally we would pay 15%, and if our income is low enough, you might even get them for free. But maybe not. Okay.
Is that in 2018 tax year, 20%?
21% that's the new corporate rate. For corporations, the new tax laws, they were the best for the corporations.
Is it 21%?
21%. It's good. We're going to get there in a page or two. Okay, control groups, personal service corporations. If you have control groups, they sometimes have to file tax returns together. Sometimes you have different sets of rules for control groups. Most control groups, if it's 80% total voting power or 80% of the total outstanding shares of stock. Okay, so if you have a parent subsidiary, that means the parent owns 80% of the other guys. Okay? Then and here's a diagram down below where you can have them where their parent subsidiary, one guy could own all the corporations, or you can have a brother or sister relationship where you own several different people, 5 or less, own more than 80%. Okay, then there's also the 50% rules. And we've done the 50% rule. It's going to be in this chapter or the next one we're going to go over. Remember, we've been doing the 50% rule if you know, it's called related parties, brother, sister, parents, kids, or one guy and a corporation that he owns more than 50%. Those rules still apply to all this. They're different than the 80% rules. Okay, but they're still there. Me and my corporation, I sell a piece of land to that corporation. I have a loss, I don't get to take the loss. I sell a piece of land to the corporation, I make income. Instead of having it being capital gains, it's ordinary income. This we've done it in part 1, and we've already done it earlier in part 3, or 2, whatever this is, part 2. But okay, you guys got that? That's still gonna apply. So they're gonna maybe trick you in a problem and say each of them owns 75%, and you're gonna have a loss, and how much of the loss can they take? And the answer is none, because it's still over 50%. Okay. Sometimes if you have over 80%, they're also going to end up, they're going to file tax returns together.
As a corporation?
Huh?
How to file tax returns together?
Yeah, the corporations will all file as one corporation. We'll get there, and I kind of got out of line here. Okay. There's limits on tax benefits if you have all these corporations. Let's just say one guy owns 3 corporations. They all have to file together like they're one corporation. They can only have one 179 limit. Say the 179 limit now is what, $1 million? And if your total assets are more than 250, it starts phasing out. 2.5 million, I'm sorry. 2.5 million, it starts phasing out. Well, that would apply to the whole group of corporations. If they're all, yeah, let's just say one guy owns 100% of this one, 100% of this one, and 90% of the other one. Well, then they would all file, they would combine them together. They would be called a control group. Personal service corporation is, if it meets all the following, they have all the rules. Basically, you just read that, or else I'm just going to be reading it to you. Tax return filing. Hello. Have you taken part 3 yet? Have you been studying for it at all? Have you considered taking part 3? The reason I'm saying Edna just called, she just now passed part 3.
Oh.
She's going to probably give up on part 2 for this year and come back next year, because she hadn't studied part 2. She studied for part 3 and is now past 2 parts. You've gotten part 1, and I'm suggesting you do that same thing. Pass part 3 and you do the same thing.
You have part 1?
Yeah. 2 Februarys ago, so I have to pass the next 2 parts within the next 2 months.
February?
Yeah, otherwise I gotta start all over again. Time really flies by.
We have until July after this.
Yeah, for this
the
book.
access. Yeah, for the access.
Oh.
So
Oh, no,
you
mine's
could,
Let's spend it.
so you could pass part 3 now,
And part 2.
and then study, finish part 2, then go back after tax season and crank through it all again. But if you passed them all, even the worst that would happen is you have to buy another book. Oh, killing. Wasn't it you one year that we just finished, we sit in here and you finished your own book?
Yeah. You printed it for me.
The old ones, their books weren't like this. This one has a backing. Ours were just like you printed the book yourself.
Oh, like this.
Is that, yeah?
Yeah, I printed offline. So I don't have the question. You know how in the back of those books they have questions?
Mhm.
Mine's is online and it goes through it, which is kind of good, but
They have the questions online,
yeah. Like,
but they won't let you print them, or you don't bother. Well, if you can do it online, why? Because I go through the questions one time to see, make sure I've got it. But other than, a lot of times I don't even write, if they're easy, I don't even, go like, write the stuff down.
Are we gonna have more changes on this next year?
Nope. Well,
So,
to be determined. You know what's getting ready to happen on the 20th?
yeah.
December?
Uh-huh. The Congress is supposed to go home, and if they don't have a new continuing resolution, the government shuts down again like it did 2 years ago. Remember for Christmas and all of January, the government shut down? Mean old government. In the last few days, the government, something has been going on. It could be the bad weather, but it's hard right now to get through to anybody.
But there won't be that many changes.
Right now, not unless Congress does something, they haven't passed any laws. All they've been doing,
So this book will still be good for next year.
Yep, unless they change something. Saving money. Okay, so on page 278, you're gonna, for corporations, you use Form 1120, and for S Corps, 1120S, and for C Corps, when you use 1120, you get 4.5 months. So if you had December 31st as the end of the year, you get January, February, March, half of April. It's the middle of the 4th month. So it's really 3.5 months, not 4.5. But an S corporation, which we're not going to get to till next week maybe, is 2.5 months, just like a partnership. You have to have it by March 15th. But the way that they're going to ask the question, they're not going to have a company that ends on December 31st. They're going to say something like June 30th or September whatever. They got to be the last day of the month, no matter what. Okay. So, what is it? C corporations, the 15th day of the 4th month, so April 15th. S corporations, 15th day of the 3rd month, March 15th. They've got a little deal here on page 278. They've got a special rule for June 30th. Because June 30th, you should get 3.5 months. So what would that be? July, August, September, October 15th. 6-month extension from June should be July, August, September, October, November, December. Well, they've made, I'm sorry.
Yeah,
They give you, let's see, they give you to April 15th for some reason, which is not, it's like an extra month. I'm sorry. Right now, so if you're if you look in the middle of the page, if you have, this is the only month that's like this. If your ending is June 30th, you only get 3.5 months. If it's any other month, you would get 4.5 months. Do you see how that is? That's just a goofy thing. But no matter what, they would give you till April 15th, which is like 7 months. I don't know why they do that. what they do.
Needs to be filed.
Yeah, I just wanted to point that out to you. June is not like any other month. So they only give you 2.5 months to file your tax return, but they give you 7 months extension. So go figure.
So if it's June 30th, then you have to file.
Yeah, and the
by
real problem is that on your test, they're gonna give you a question like that probably.
September 15th, you have to file.
June, so July, August, September 15th. That's right. But for every other month, you get 3.5 or in the middle of the 4th month. So June gets cheated out of a month. What is the penalty for late filing? You already know all this stuff. 5% per month for 5 months or 25%. Minimum tax. I don't know if they would ask you that, but if your tax is more than 60 days, it's the smaller of the amount of tax you owe. So if my total income tax for the year was $1,000, it would be $1,000 or 210, which is 210. So I'd only owe 210. On the other hand, if my tax I owed was 150, then or 210, at the end of 60 days I'd owe the 150. All these things I've just been going over, only reason you need to know those are for the test. Other than that, it's not going to be a big deal. Okay. They may ask you this, I doubt it. So corporations having gross receipts and total assets of less than $250,000, they don't have to required to file other tax forms that all the other corporations do. They're called Schedule L, Schedule M1, Schedule M2, and then if you have a big enough corporation, there's a Schedule M3. And it's like some odd $1 million, either 10 or 25. Let's see if I can find it. We'll get to it. Okay. This is another one that's not real used a lot. If you shut down your corporation, you can require the IRS to give you an assessment of the tax within 18 months after you have shut down. The date you request to file. So normally they got 3 years, right? So 18 months. If you want to just get all your bills paid, close this thing down, get it all, give all the assets away to somebody, you can say, I'll give you 18 months. And the IRS will have to tell you if they're going to audit you within 18 months. That doesn't mean that if they they go, okay, we're just going to audit you. They can still drag the audit out as long as they want.
18 months to file the final return?
No, you file the final return, but instead of them having 3 years to decide whether they're going to audit you or anything, you can file this form. I don't remember the number, but it is there. You can file the form and say, I want you within 18 months. Let me know if you're going to audit me, and I can provide you the information. Because why? I want to close the company down, pay all my bills, pay the IRS. Because you've got to pay the IRS before you can give all the assets away to the owners. Why do you think that's important? Because if you, as the guy in charge, give all the assets away to the owners, and then the IRS comes back and charges you a lot more money, well, you, the guy that's in charge that gave could be responsible if you can't give if the guys choose not to give the money back. Oops, surprise. And so that wouldn't be very good, huh? I don't know why they have in here where you file, but here in Hawaii, we file our stuff in Ogden, Utah. Accumulated earnings tax and alternative minimum tax amount. Okay, so alternative minimum tax Okay, so accumulated earnings tax. Basically, you start with your taxable income, and you just go down this. At the end, you have to know that you pay 20%. What is accumulated earnings tax? Glad you guys asked. Let's say that I have a company and I make a bunch of money. I should keep a little bit away for emergencies and things we need to do. And if I have some big plan, I can keep other money away, but I have to say what that is. But other than that, I'm not supposed to keep over $150,000. I'm supposed to give that money to the shareholders. And if you keep too much and don't give it to the shareholders, they charge you a tax of 20%. Okay, now do you see how that works? And here's all the little numbers and everything that you do to justice. I don't believe they're going to give you a complicated problem on this, but they will maybe do one or two little things in there and say, I have a net income of $1 million. I gave $500,000 away in dividends, and I have $300 set aside for some construction project. That would leave $200 left, 200 grand left. I subtract 150, now I've got 50,000, so I kept too much money, and so 50,000 times 20%, I would have an accumulated earnings tax of $10,000. I could do that on the board, but you're not gonna. That's about all you're gonna get on that one. But you see, what you have to know is what? What is the percentage? 20%. That's the key. And then, what are the kind of things you would have to deduct? If you had things like net operating loss, excess charitable contribution, there's a lot of other little things. They're not going to hit you with that nitpicky stuff. Okay, estimated tax payments. On a corporation, you're supposed to pay estimated tax payments. How much are you supposed to owe these guys at the end of the year? Less than $500. That's double the amount. Wait, that's half of the amount that you can owe for your individual tax return, right? Normally you can owe up to $1,000, and they're not going to get you for estimated tax penalty. Well, here it's $500. And when do you have to pay them? The reason I'm showing you because it's different. Okay, there's going to be April 15th, then June 15th, September 15th, but instead of January 15th, it's going to be December 15th. Okay, and that's if you're a calendar year, but the same things would apply. 4th, 6th, 9th, 12th. And so what I would do is if they gave me any other thing, a fiscal year, I would remember the word April 15th, June 15th, September, and then count. So from December 31st, 1, 2, 3, the middle of the 4th month, April, that's the first one. 1, 2, 3, 4, 5, 6, that's June 15th, that's the second one. And that's instead of trying to memorize all that, because you might not even get a question on it. Okay? Each quarterly estimated tax payment requires 25% of the lesser of 100% of the prior year tax or 100% of this year's tax that you're going to owe. Okay? It's easy to figure last year's tax. That's the same as on a 1040, right? 100% till you go over a certain amount. Okay. The this year's tax for an individual is 90%. For corporations, 100%. Okay, paying the 100% of the prior year tax is not an option for a large corporation. That's a number 4 on page 281. Income above $1 million to any of the 3 preceding years. They have to pay 100% of the current tax. That's their only choice. And, okay, as a guy that does this on a bi-weekly basis, how do you put your deposits in? There's no more going down the bank. You have to do it with EFTPS. And that's just the electronic filing. You can have it directly taken out of your bank account. That's the easiest way. You can have if you had somebody else doing your payroll, like if I was doing payroll, I could set it up so I did it for you. And that's what a lot of most payroll people that I know, when they do payroll, they pay all the payroll, pay all the taxes right then. Is that what, do you do payroll?
Yeah, I do, but then I don't do it that way. I know a lot of other places do it, Ceridian.
They take it, boom, pay right then. When do you pay?
Well, it's due.
When you have to?
Yeah, on the 15th, so I set it up like a EFTPS, like maybe on the 3rd. I make sure that it's paid on the 15th.
Yeah, you can select the date for
Yeah.
for EFTPS and.
Now
with
the state.
State,
The
but
state.
not the unemployment.
Yeah.
You cannot set the date. It's like
No.
you have to wait to.
Yeah,
close
that
to the
day.
end.
I don't.
Oh, you collect in advance?
I'm only doing it for my own company.
Oh,
So, it's
Yeah,
my
but-
money. I get to do what I want.
We try to make it the latest date for the client.
Yeah,
Oh.
just two.
Yeah.
I would not like that because some of my clients are a little sketchy and I don't want them to, I want to make sure the money's there.
I only have one client.
All right.
It's like, show me the money first. It's like,
I doubt they're gonna ask you, what is the form if you have underpayment of taxes? It's a 2220 form. And remember, we said that if you owe them less than $500, there's no tax liability shown on the return if it's less than $500. There is something. Okay, so you paid a bunch of estimated taxes, then all of a sudden in the last quarter, your business had a great big catastrophe. We had a hurricane. You didn't make any money. You lost a bunch of money. So that means you've overpaid your estimated taxes. There's a form called a 4466. You can file that as soon as the next year and then go and say, I want my estimated taxes back, even before you file your tax return. I've never done that, never seen anybody do it. And we've already told you most of the federal tax deposits are done electronically. There's an exception. If it's less than $2,500, you could file it with your 941. I've never done that, but if you had a small enough company, you could. Any questions about this chapter? This is pretty straightforward, but this is the beginning of corporations. The next one gets to be more fun, because after you get the corporation set up, then you're going to start selling your stock. You're going to either sell it for cash, for money, or you're going to sell it for property or for services. Okay? So, if you first, this is where the middle, the rubber meets the road, so to speak, and all this. If you buy to a corporation and you give them money for stock, okay, you're buying the stock for the fair market value, right? There's no problem. If the stock is worth $25,000, you give them $25,000, boom, no problem. On the other hand, that's no matter where you sit. Okay, if you own more than 80% of a corporation, if you give them cash for stock, that's the same deal. But if you give them property for stock, then your property might be worth $100,000, their stock might be worth $75,000, but since you own more than 80%, it's still a switch. There's no capital, there's no gain or loss. Okay? But what happens if you only own 60%, 70% after the transaction? Okay? Or you earn 20. Remember, if you own 50%, you can't take a loss. Right? But if you gave them cash for their stock, you generally probably wouldn't. On the other hand, what if you only bought 10%? You gave them cash for their stock, just you, whatever you paid for the stock is your value in the, right? They could have on their side, if they gave you stock for cash, then they just gave you stock for cash. On the other hand, here's where it gets fun. They gave you a $50,000 dollar property, and the stock was worth $60,000. You're only getting 24%. So you ended up getting you have a 10% gain, because the basis is only 50,000, but this piece of property might be worth 60,000, might be worth 70,000. It doesn't matter. Its basis is 50. You get $60,000 worth of stock. You don't have 80% or 50% ownership, so you've got a gain. That's really kind of simple, but there's a lot of combinations we're getting ready to go through. Okay? What happens? You got $50,000, but the basis was $80,000, and you have $30,000 worth of depreciation. So your $10,000 that you got is ordinary income up to the, okay? Could you have a loss? Okay, you're $50,000, but they only gave you $40,000, because your basis is $50,000, but the fair market value is only $40,000. Okay, just say it's a piece of land. Your basis is 50 grand. There's no depreciation. The fair market value is 40. They trade you $40,000 worth of stock for this. So you actually get a loss, and you get to take that loss. This is just a straight, they gave you stock for land. It's going to get more complicated in just a minute, because that's if you have for sure less than 50, but for 50 or 80%, depending on the circumstances. So you're not in control of the company. When you hit 80%, you're in control of the company. You could trade this 50,000 for that 40,000, and you don't have a gain or a loss. We're getting ready to that's what we're getting ready to go in. So what is the rule? The rule is called 351. We're on page 293, recognizing gain or loss. If you're in control of the corporation, this is non-recognized treatment is mandatory. You don't get a choice. You don't get to take a gain or a loss on all this. You're just switching, because you are the company, really. You got more than 80%. Just say it's 100%. Control of ownership is 80% more of the voting stock, and 80% more of the shares of the non-voting. Okay, that's one thing. Now, we've been doing this one all along. On the other hand, I don't trade cash. I don't trade property. I trade my services. I'm a lawyer. I do $40,000 worth of work for the company, getting it set up, or whatever I did lawyer for, getting Epstein out of trouble. Nah. But my lawyer, the lawyer does $40,000 worth of work. The value of the stock that he gets is $40,000. He has a basis in the stock of $40,000, and he has $40,000 worth of income that he puts on his tax return. And if it would probably be contract labor in this. He wouldn't be a W-2 labor, so he would get Schedule C labor.
You'll get a 1099.
And he should get a 1099. Okay. Non-qualified preferred stock. Here's you just a list of when it's non-qualified preferred stock and it's treated as food received and is not counted as stock towards the 80%. Just at your convenience, just read that. Or if you're not going to be taking this test until next year, that's the kind of stuff you're going to want to read. You didn't read these chapters, did you?
I did.
Oh,
You mean this chapter?
yeah. Last week, none of these guys read it. So that's why I'm going faster today. I didn't realize. Okay, solely for stock. To the extent the shareholder receive the corporation stock in exchange for property, non-recognition is required. Remember, we're 80%. You don't get to choose. It's a requirement. Sometimes you can have a sham transaction where they you trade property for stock. Either way around. You trade stock that has a value of 100 grand, you trade it for a property that's really worth 30 grand. Okay? And you trade it right across. Well, that's a sham. You're really, in effect, trying to trade your property for the stock, but you're really giving yourself a hidden dividend. Okay? And so they would say, no, that's a sham, that you would have to count that if the IRS caught you, and they would say you gave yourself a dividend. So dividends are what? Ordinary income. And they'd make you count it as ordinary income.
How can we explain that again? He traded his land that's 30,000 for stock.
For the 100,000.
For the 100. Oh, he's getting the stock and he's giving
Yeah.
stock. Okay.
And it's really not given in the stock. It's a trick. Or it could be the other way around. He's selling his stock that he says is worth 100 grand, but it's not, because he's the old owner. This is one of my favorites. I own 100% of a company. I've got $100,000 worth of stock. If I sold let's see, if I sold some of the assets to somebody else, I would still own 100% of the stock, right? So I could sell it for a gain or a loss, and it really wouldn't matter because it's all my money. I still own 100% of the stock. So that's why the IRS says if you're owning 80% or more of a company, you can't be selling. This is not a real fair deal. You own both sides of it. Okay, so The section 1, they say it, they call it section 351. If you own 80% of the stock, even if the corporation issues no stock in exchange, can apply to contributions of property even if the corporation has no stock in the exchange. Capital contributions by a sole shareholder who receive no stock in exchange is still a contribution. He owns everything. It doesn't. He could give them 50,000 or he could take 50,000 out. He still owns the whole company. So there's no gain or loss there. Boot is when, okay, the shareholder recognized gain up to the extent of money and the fair market value of the property. So how would that work? Okay. I give $50,000 of stock, and they give me property worth $60,000, and they give me $10,000 of cash. So in effect, they gave me $70,000, okay, for my $50,000 of stock. So I made a $20,000 gain. So, but I only have to pay capital gains on the gain. The recognized gain is $20,000. Excuse me. The realized gain is $20,000. But I only have to recognize or pay tax up to the cash and other unlike property. In this case, the cash was 10 grand. So I paid 10,000. I pay tax on the $10,000. That increases my basis up to $60,000 by coincidence. 50,000 plus 10, because that's what I pay tax on. So my basis in the property that I got is now 60,000, and I paid tax on 10,000 of the cash that I got. This is kind of like the old like-kind exchange from part 1, but it's not exactly. And here's the real kicker. Okay, the next line down is that what happens if you have a property but you have a mortgage? If the mortgage on the property is less than the value, it doesn't matter. So I have property worth 50 grand and it has a $30,000 mortgage. I exchange it for, we'll say we'll just say $40,000 worth of stock. Remember the rule that we've got? I own, after this transaction, I own all this stock in the company. So I changed this $40,000 for this $50,000. There's no gain or loss. So my basis stays the same as it already was, and this you don't subtract.
Because you're 100% owner?
Yes, or at least an 80% owner. Okay, now if you have a loan, a mortgage of $60,000 on property that has a basis of $50,000, now there's a different rule that says now you have a $10,000, okay, that you would have to pay capital gains on, because what you're giving up property, but the loan, the mortgage is bigger than the property's value, so you would have to pay tax on that $10,000. But now you have this property, the corporation does, and it would add the $10,000 to this, and so their new basis would be $60,000. This is basically, it's in the book just pretty much. But this is what I want, because this is, you're getting kind of what you're gonna get a problem on, all of this stuff that we've been going over. This is the basic, but this is, if you've read the chapter and done the problems at the end, it will seem easy. And any of you guys, we're down to so few people now. Anybody here that wants to make an appointment, come in, I'll be glad to help you. If you read the chapters first. Okay, so you had a, so if you recognize gain, you can only recognize gain on cash or other property. If the liability is bigger than the basis, then you would recognize some gain. But if the basis was 50 and your liability is 40, you don't recognize anything. Okay?
Say that again. If your basis was.
If your property was worth $50,000, but you had a $40,000 mortgage, you just trade property for stock. Your basis might have been $50,000, but the fair market value could have been any number. It could have been $100 grand or $200 grand, and you may be trading the stock not according to what my basis is, but according to what the value is for the company. But if I'm getting 80% of the company, who cares? It's my company anyway. So what would that do? I traded stock for the basis, even though it might be worth 200, 100 grand. Its basis to me is 50 grand. So now its basis to the corporation is 50 grand. And if the corporation sold it, I'm the whole corporation. The corporation, in effect me, would have to pay capital gains on all that. Okay, so now we're going to the old 50% rule. We've already gone over this 2 or 3 times, but it's in here. Remember, I could own 50, 60% of the corporation, but then that rule about the stock ownership doesn't apply. What does apply is still the 50% rule. If I own 60% of the corporation, not 80, then there's no such thing as the no gain transaction. But your transaction would have the different rules. Remember, if you have a gain between related parties, I own 60% of the corporation, so the corporation and I are now related. Then if I get a gain, it's ordinary income. If I get a loss, I can't take it. So one of them gets a gain and a loss, one of them didn't get to take it, and the other gets it as ordinary income. We've been going over that one in different places 2 or 3 times. Okay, if you'll look down at the bottom, oh wait. No, okay. So, basis of asset transferred in exchange. So, the basis, if you'll look at 12.2, okay, basis of shareholder in stock, basis of the control group shareholder in the stock of a corporation is the adjusted basis. And here's a little formula. Adjusted basis in contributing property is minus boot or money, then liability relief, fair market value. This is not the same though. Fair market value of property given up. If remember before I give you a piece of property, you give me another piece of property, and money and a truck. So you give me unlike kind property, you give me money, and so you could have gain up to the unlike kind property and the money. The difference is you don't count the liability, I think. Okay. So, if the guy that gave you the property has to recognize a gain, you add that back to the basis. But normally you take your beginning basis, adjusted basis, and you would subtract any cash that they gave you. Okay? All liabilities assumed by the corporation are treated as boot when computing stock basis. Okay? If a capital asset or other assets are contributed by a sole proprietor when incorporating a business, each share received in the exchange has a split holding period. I don't know what that means. Okay, boot generally has a basis equal to the fair market value of the boot, such as I gave you a truck. The basis of shareholder in stock received the services is his fair market value. Like the lawyer I was talking about, I gave him $40,000 for his work. His basis in the stock would be $40,000. His income for doing the services, he has to declare on his tax return as $40,000. And then later on, if he sold that stock for $50,000, he'd end up having a capital gain. And if he later on sold it for $30,000, he'd have a capital loss. We've already gone over this before real quick, but corporation, organization, startup costs, remember, you can write off for each of those $5,000 in the year you start the company. What do you have to do before you can write that off? You got to start the company. You can't write it off until, so you have a bunch of clients that come in every year and they go, oh, I spent this and this. I spent $400 here, $1,000 here, $2,000 there. And you go, well, when did you start the company? I started it this January. Wrong answer. So they didn't start the company last year, so they have startup costs, and they can't write them off until the year they start the company. If you have a corporation, besides startup costs, you might have organizational costs. Okay? So what would be the organizational costs that are different than startup costs? I'm glad you guys asked. Okay, so startup costs, only expenses that would be deductible if paid for an existing trade or business. Well, I did research to see how to market the company. I had to hire the employees before we started to get them trained. I had to do some advertising, that kind of stuff. Okay? Those would be startup. Then on the organizational, relating to issuing the corporate stocks are not amortizable expenses. So, if it's to organize and get the stock ready for sale, you can't write that off. It has to be capitalized and kept until the end of the business. What can you write off? I'm glad you asked. Examples would be expenses to get a corporate charter, fees paid to the state for incorporation, expenses for temporary directors. If you had to hire some directors that weren't investors in the company to help you do this. What are the ones that I want you to know that all the stocks, let me just see it. Okay, expenses. These include the sale of stock, related professional fees, printing cost, and cost of listing the stock on the chain. Those are the ones you can't write off as organizational. Those are the ones you have to keep till the end of time. And then you get to expense them out when you're closing the corporation. That's a good cash to that as a question. So, and it's the ones that have to do with issuing the stock mostly. Okay, so you used to have to put a letter in there with it if you were going to write off those costs. Now, if you take off the startup cost the first year, you can take off up to $5,000. If your startup costs are over $50,000, we'll say over $55,000, you can't write them off in 1 year. You have to amortize them, and you amortize them over 180 months. So if you started the company on January 1st, you'd get 12 months that year. If you started it on July 1st or June 30th, you'd get 6 months. So you divide 180 into all the cost, and that would give your cost per month, and the number of months that you were in business that year would give you the total. Is that pretty? We've gone through this 2 or 3 different times. You guys remember this at all? Hope so. Okay. So what happens if you have startup costs? You have the cost, but then you don't go into business. This is where your client gets mad at you. The answer is you don't get to write them off. Okay? That's on the bottom, that's under C1. If the taxpayer is already in business, there's no problem. You get to write off your startup cost. That's just part of the business.
Any business?
Well,
Schedule
you're in
C or, yeah.
You couldn't, if you're in a construction business, you probably couldn't write off the cost to start an ice cream store. But if you're in a construction business and you want to expand to different locations, that would be no problem. You just write those off. There was no worry about startup costs. Even they are a startup to a new location.
And you have to apply for a EIN number?
Maybe, maybe not. If you're in construction and you ended up starting a new office, do you need a second EIN number?
No.
Not necessarily. If you're in construction and then you want to start a clothing store, you would probably need a different EIN number and a different DCCA, DOL, all that. You'd have 2 separate companies. Any questions about this chapter? The key is what happens, it's the sale of the stock. The trade, you're buying the company. What is the rule? If it's 80% or more, you're limited to, you wouldn't have any gain or loss up to the amount of boot. If you just trade property for stock, there's no gain or loss. If you trade property for stock and you give the guy money, then you can have a gain up to the amount of money that you gave him. Okay? Or he would get a gain up to the amount of money you gave him. You would deduct the cash you gave him from the, let's say you gave him $30,000 of stock and $10,000. The stock was worth $30,000. He gave you a piece of property worth $40,000. So you would add the cash basis to his property and add $40,000 in the basis of the property that you got. If you'll go to page 3, does anybody here want to go to the restroom, take a break or anything? This would be a good time.
That could be dirty.
they gotta pick up something. Okay? See, if you're not reading them, I can get you through 3 chapters a night. You won't be here on Christmas Eve. I was thinking maybe anyway, not doing that, maybe the day before on Monday.
Oh, yeah, I thought we were doing Monday.
Yeah. So that would be the last day, but if it's just gonna be a few people, this happens every year. Normally, I used to start off with 20 or 30 people. The room was 4 times this big.
Wow.
And by the end, it would be the last 3 to 5, usually about 5 people. And 3 out of that 5 would pass all 3 parts, and the other 2 would pass some parts. But that's, by coincidence, it's the people that read all the chapters and did all the problems that stuck around till the end. Just go figure. And you know, the truth is, okay, the people that did this, now one guy last year, he has a PhD and teaches business at UH. He got through it. But he'd also been working for 10 years for H&R Block. He passed. But he also studied and did every chapter and all this stuff, asked questions. The other guy was my son. He studied twice as long as this guy. He studied 20 hours a week. But it worked. And he also was in this office, so he couldn't kind of like blow it off. Somebody would give him stink eye. Or even better than that, when he had questions, I would stop and go over it with him, which made it easier, which I've offered to you guys. Okay, so we want to go to chapter 13 on page 311. Okay, so we're going to go over income, losses, deductions. What's the first rule? Everything changed last year. Now, everything to do with tax returns is 21%. There used to be, you'd have one tax rate for the first $50,000, another tax rate, then a third tax rate, and then the income would go back down to a lower tax rate after, I don't remember, several $100,000. That's no longer. It's all 21%. So, after you hit, for a single person, after you hit about $37,000, $38,000 of taxable income, you're paying a higher tax rate than billion-dollar corporations. You're paying a higher tax rate than a corporation that has any amount of money. But really rich, important corporations, billionaires, are paying a lower tax rate.
That's not fair.
Yes, but the guy that's running our country right now, is he a rich billionaire or is he a poor schmuck? Does he care about socialism or does he care about the rich getting richer? And it's one of my pet peeves that he's doing everything he can just the way he feels, you know. And what he feels is we don't care about things like polluting the rivers, polluting the land, you know, global warming. It's in the way of business. Never mind. Killing poor little animals. No. We don't care about making little animals extinct. We care about making money. It's what he's all about. And some people go, I don't care either. I want to make money. There's a certain part of our population that's just the way they are. That's kind of not the way it is in Hawaii. But if you were in Kentucky, Tennessee, you go, to hell with pollution. I want to burn coal. I get a big salary if we burn a lot of coal. So what if it just pollutes the world? What was there? There was something that Cole called acid rain. they had just about stopped acid rain. I think Mr. Trump is starting to reverse all that. So, but it doesn't happen right where they're burning the coal. It happens downwind, because all of that, okay, what acid rain is, that the particles go up into the air and keep rising, and then they keep floating in the air, and they finally come down a long way off as acid rain. Not good for some things, plants, trees. But if you happen to own a coal company, you're doing good. Sorry, again, that's my little pet peeve today. I promise to stay away from that. Okay, where was back? So, instead of having high rates for companies, we're now down to 21%. Remember I said over 38,000 for a single person? You're in the 22% tax bracket. Yeah, and it's about 78,000 for married couples. 50,000 for head of household.
It's 22%.
Yeah. That's not in this week's chapter, but it's a personal.
And we need to know for the individual.
Okay. Remember we said if corporations had less than 250,000 of assets and gross receipts, gross income they're not required to do the Schedule L, Schedule M1, Schedule M2. What is a Schedule L? It's a reconciliation between your book income and your taxable income. This is important because to show if your taxable income is way different than your book income, it can be that way. We're gonna get into that. The next thing is M1 is a reconciliation analysis of the unappropriated retained earnings. I'm sorry. M1 is that. What a balance sheet is Schedule A. M1 is tax books, taxable income, and book income. M2 is reconciliation of returned earnings. So we'll get into both of those all the way. You kind of need to know that. Do either one of you guys do C corporations? Okay, then you've got to do all this, and you better hope your software gets it.
Oh, yeah. That's where I get stuck on.
Every now and then you get to the point where you can't see how to make it work. And if you can't do that, you can't finish the tax return until you can either call your software company, why is it not working?
Oh, the penalties, that's why. Okay, that's right. Penalties go into a different screen.
Yeah.
Pro Series?
No, Drake.
Oh, yeah.
I always forget where the penalty is a different screen from the M2 screen, the M1 screen.
Okay, reconciliation. Okay, so this is what we're really going to talk about. And we might as well just go to the next page, 312. I'm going to do you an easy one really quick. So you're going to start with book income. Okay? And we'll say we start with book income and you have 100 grand. And then you're going to make all these calculations until you get to taxable income. Okay? If you pay income taxes, they're deducted on your book income. Okay? Let me just go through a bunch of them. Capital losses, they're deducted on your book income. Okay? But you can't take capital losses on your taxable income. You can't write off your income tax as an expense on your taxable income. Okay? Sometimes you have income that's non-taxable income, non-taxable interest, we'll say. Well, they counted it up here, so you'd have to subtract it. So you're going to go through, we'll just go income tax. We'll say it was, you paid $20,000. So you would, you already subtracted it, so you would add it back. So to get to your taxable income, because you subtracted it from your book income. Then what else do we have? Capital losses. So your capital losses were 5,000 more than your capital gains. And we're going to find out that your capital losses cannot go higher than your capital gains. Okay? So you would add that back. We also said, oh, we had $10,000 of non-taxable interest. Okay? And we had $500 of interest expense. So the $10,000 of non-taxable interest was included in income, so we're going to have to subtract that out. So that would be a minus, and our $500 of interest expense that had to do with this $10,000, we got to subtract it out, so we now add it back. And then at the end, we just do the math, and you come down to the correct number. If that's what, you're going to get a problem in that for sure. Here it is, right in this page for you, though. And I've got the word no beside it. K-N-O-W, not no.
Oh.
So what it would be, so
It's good to put the figures here in place of the words.
125 minus 10 is 115. 115.5 would have been the answer, if that's was the problem. And there was more things that I didn't put down in there, but you're just going to do, when you see the problems, my suggestion, when you do the actual problem, turn over the problem and turn over here and go back and forth and look, just to make sure you got the pluses and minuses right. Until you, it's kind of easy. Same thing now. The next one is for the M2 is retained earnings. You start with the beginning retained earnings. You always add your income. Then you might you'd subtract your dividend. Oh, if you look down on 7, they have it. Income, other expenses, including a refund of federal income taxes. You would add that to your retained earnings because you got money back. Okay? Then you would subtract out your dividends. And then you'd have maybe things like other decreases. Anyway, so you get to your new retained earnings. If it was really simple, your retained earnings would look like this. Beginning retained earnings, $40,000. My income for the year, net income, $80,000. My ending retained earnings, $120,000. But we're not supposed to leave all our retained earnings in there, so we would have to take out dividends, or we would get that penalty we talked about. So we said $40,000 beginning. Then we had, what was it? $80,000 of income. That would give you $120,000. Technically, we could keep up to $150,000 in here, so we would be okay. But we want to give dividends out for the people that own the company. They want to get some goodies for all this work they were doing. So we'll say that $90,000 in dividends were given out. So you'd have $30,000 of retained earnings at the end of the year. They're going to very likely give you that problem, and it won't be much harder than that. They might throw some of these other little bitty things in there. What would be one of them? If you had a tax refund, that would increase. If you owed money, that might decrease it. If you had some other kind of, let's say that, oh, we had to put some money aside because next year we're going to have to build a new building. So we took out $20,000 and set it aside and then you would be subtracted. It's there, and do either one of you guys think you're really gonna take this test this year? You think you're gonna give it a shot?
Not
Is
this
this
year.
one part two?
Yeah. Or
Probably
next year?
in January, I have to do it. I mean, cause like I said, I'm gonna lose out on both, everything, if I don't do it by February.
No, you won't. You just have to go through one again.
Yeah, I guess.
If you get 3 done now,
Mhm.
it's good for 2 years.
Oh!
Oh, it won't end at like
Oh.
your first one. It's
Yeah, I
just
thought it
like
ended after the first
That's
one.
yeah.
Oh!
So each one is 2 years after.
I think so. I haven't,
Yeah, you haven't done it in years. Oh.
only 30. What? Who's counting?
Yeah,
No
you
way.
would think so.
I thought it was like from the time you start. That's like it starts your clock. So
For all 3 years.
yeah, all 3. That's what my understanding was. Honestly.
Well, if you got one of them 2 years later, you might lose. Well, I know on the CPA exam for my son, that's the way it is.
Oh,
Because he just went through that. Now he's having to retake the 4th one that was the first one that he passed. Because he waited too long to get them all passed. Because they're not as easy as you might think.
No, it's not. That's
so
not
how many years
expensive.
is for the CPA?
2.
2. And so all exams have to be completed within
Yes,
the first
but
one.
if you did 1 here, 1 here, 1 here, and you get to the 2 years here, well, these are still good.
Okay.
But if you pass this one after the 2 years, you still got these 2.
Uh-huh.
This one you got to retake again. That's where he is right now, and he's going to retake it in January.
So EA should be just the same way.
I hope so. I gotta go look it up.
I want to take 1 and 3. Maybe 1 this year. That's how I use it.
Yeah, let's look at what the don't pass exam.
1 is the most basic, the best for you to know.
Yeah.
3 is the easiest. But if you it depends on how much work you've already done on any of them. All right, so we're going to go to page 313. Do you guys know anything about dividend received deduction? They changed the whole thing this year, so it doesn't hurt that you already learned it the other way. For me, I learned it for the 20 years the other way. Now I got to get it again. So they changed all this. So here's what we're talking about. I have company A. I own stock in company B. Company B gives me dividends. We'll say they had $40,000 of dividends. I own the whole thing. Or I could own under 20%, between 20% and 80%, between 80 and 100. Okay? So under 20% now, it's 50%. Okay? If you own between 20% and 80%, it's 65, and I believe it's 100 for over, or at least in some circumstances. So what does that mean? I own under 20% of the company. My shares equal 20%, 19%. If I have 20%, I get a 65%. What is it? So I have income. Let's just say my regular income is $80,000. I have dividend income of $40,000. So that's $120,000. So they pay tax on their $40,000. We're going to say I own almost 80%. Well, they've already paid tax on this, and I'd be paying it again. So what they have is, we're going to say, actually I own less than 20%. And so we're going to say on this 20%, I would pay 50% of the dividends, or 50% of the income, whichever is the lesser. So 50% of 40 is less. Who would be calling at this time? Great.
Oh.
I am not gonna answer, I don't recognize
Yeah,
it.
I do that.
Huh?
I guess we all do that, because we get too many scams.
I don't do that normally.
Just the other day, it was so weird. I was at home and it said my office called. Nobody was at my office. It said my company name on there. I was like, what the heck? Didn't have the, it wasn't our phone number.
Oh.
Yeah, probably not one of those calls. You know how they say, oh, it's gonna have someone else's name on there that you recognize, but it's not them.
Okay. So, what we get to do is subtract, this is called what? The dividend received deduction. So we get to subtract, we're a less than 20% owner, we get to subtract 20,000 or 50% of the dividends. So we only now pay tax on 100,000. Is that a good deal? That helps you out when you have dividends of another company. Okay, so we're going to go through all of these combinations real quick. It's easier if I do it at one time. So, the next guy, that's right. So, if I own 20% or more, I would get the 65% deduction. This is a lot worse than it was before they changed the law last year. Last year it used to be 70% for under 20% and 80%. That was a lot better deal. Okay, so 26. So here's 120, 26, and that would be 94. So now my income is down to 94,000. See the difference? And what is the difference? How much? What percentage of stock do I own? Under 20%, 20% or more.
Over 20%, so this was 65%.
This one was 65. It would have came out 26. Now, the real rule is this. It's the lower of 50, let's just say it's under 20% to make it easy. It's the lower of 50% of the income or 50% of the dividend. So if the income, including the dividend, is more than $40,000, this will always be less. But what happens if we lost $10,000 and we've got a $40,000 dividend? So now our net income is $30,000. If we subtract 20%, that would be $20,000. If we subtracted 20% here, it would be $15,000. So we take the lower of the two, and now we would pay tax on $15,000. If we could have gotten 20% of this, it would have been $10,000. You with me so far? So, we took the lower of net income or dividends. If we get down to a net operating loss position, that means when we take the dividends reduced deduction, it gives us a loss, a net operating loss. Then we get to take this one even if this one's lower. We're going to go to the book just after I do that. I just want to show you. So now we're going to go So we have a 10% income. 10% of that would be a 5,000. 50% of that is a 20,000. We now have a loss. So we don't have to stick with this number because it created a loss. We now have a $10,000 loss, a net operating loss. That's what I want to show. Those are all the different options, and you got to be able to do those as problems because they've had those since the beginning of time. So now let's look at it here in the book. So you can take your. Does everybody have a highlighter? Okay. So we go. Here's on page 313. You'll see there's under 20%, 60%. It says over 80% and affiliated. Then you get 100% dividend. Okay. Okay. What do you have to do this? First, you have to have owned the stock at least 45 days before. That's number 2. And at least 46 during the 91-day period that begins 45 days before the dividends are paid. So you have to have owned the stock. You can't just buy it right before, the day before, right? That's a question they have on there almost every year too. Now, all the questions I tell you, out of about 5 of you might get it each test, each year. You know, they don't give you everybody doesn't get all the same questions. Okay. The corporation cannot take a dividend received deduction if it holds a short position in a somewhat similar stock. I didn't even know that. So that's all right. Capital gain dividends do not qualify. That is important. Capital gain dividends are not dividends. What are they from? They're from the selling of company assets. And what happens to capital gain dividends? You get a lower tax rate. They're capital gains. What are regular dividends? They're ordinary income. Okay, so if you'll go down to 5, here's the limit. The DRD is limited by the corporation's adjusted taxable income. That's what I was showing you. So you can't take out a bigger deduction than the income, the taxable income of the company, except if it causes a net operating loss. So remember I was showing you, if your net income is less than what it would give you over here, then you have to use the net income. And the only exception is C. The TI limit, taxable income limit, does not apply if a current NOL or an NOL results from the DRD, dividend received deduction. Real quick, let's go ahead and look at 13.2. Corporation has taxable income of $1,000, including $10,000 in dividends. So the only way to do that is you had $10,000 of dividends, $9,000 of losses. That gave you $1,000 net income. And if we'll just say the 50% again. So $500 is if you use the net income, that's what you could write off. But since you had $10,000 of dividends, you get to write off $5,000. So normally you're limited to here unless this causes a net operating loss. 5,000 from 1,000 means you got a $4,000 net operating loss. Okay, so read the problem real quick and see if that's the same thing the problem says. Yeah, luckily I got and did this exact same one they had in the book. That was an accident. Okay, so you go to the next page. The DRD on net finance portfolio stock is restricted. I just want to show you this. They're never going to give you this problem. I couldn't figure this problem without the book in a million years. That's really challenging. That would be a gotcha problem. But if you'll look at number 7, you need to read this and see what are the rules for foreign corporations before you can use the DRD for foreign corporations. And number 8, it says S corporations may not claim this. Right? And what about sole proprietorships or partnerships? No, I don't think so.
It's only for personal flow through entities.
It has to be a corporation. Okay. Disqualified dividends, there's just a list. And most likely just read that before you're taking the test one time, because they're not likely, but they could. Okay. Question? Okay. Charitable contributions. What's the rule on charitable contributions? A corporation can write off charitable contributions. What happens if you're a partnership? They carry through to your Schedule A. What happens if you're an S Corp? They carry through to your Schedule A. What happens if you're just a regular person? Carry through to the Schedule A. You're starting to get a deal. So, a corporation can write off charity. They're limited to 10% of their income. Okay? They can't go back with their charity. They can go forward, I believe, for 5 years. Yeah, so they can write off charity. If they're accrual basis corporation, they can write it off. They can declare the charity during the year, let's say December, November. They have to have paid it before April 15th. April 15th for corporations. Okay, so and they don't get an extension. So, what does that mean? They can declare a charity now, and they got to get it paid before they file their taxes. Before April 15th. If they don't file their taxes on time, they don't get any extension.
Is that even for a cash basis?
No, that's accrual basis.
So it's only for accrual basis type
Yes.
of corporation? Okay.
Cash basis, no, you don't get that option. Okay, capital gains property. In general, the deduction for contribution to long-term capital gains property is the property's fair market value. The deduction is fair market value minus the amount of ordinary income if the asset had been sold. What would be the ordinary income? Maybe the depreciation? You got a recapture? Okay, so what did we say on charity for a corporation? The limit is 10% of TI, but there's a list under 5. You see a list of things that you don't count those. Charitable contribution, you don't count your charitable contributions. Okay, you don't count your dividend received deduction. That's a big one. Capital loss carrybacks. We're going to find out that if you have a capital loss, you can't write it off in the current year, but you might be able to carry it back 3 years to a years where you had capital gains and take it off against those capital gains. You with me? Okay. Excess over TI limit may be carried over and is deductible during the succeeding, it is 5 years. So you can carry it over. Okay, so what happens if my taxable income is $50,000? So that means 10% of 50,000, I could write off 5,000 to charity. But I thought I was going to make more money in December, and I didn't. So I'd given $6,000 away. I was a good boy. But that last $1,000, I can't write off. It has to carry forward, and it's going to carry forward for 5 years. If I don't get it written off for 5 years, I don't get it written off. Each year, the first you write off for charity is the charity you gave that year, then the carryover amount. You guys get that? And it would go in, first out. So, if I had 3 years of carryovers, and then on the 4th year, I made a bunch more money and I had some space, well, I'd take the oldest one first and then the next one and write those off with the charity that I was already given, as long as the whole thing stays under 10%. Sounds good?
I have a question. Does it somehow affect the accumulated earnings later on, like for any deductions that you can't take? Just trying to think if how it would affect the M2 later. Or does it?
Why would it? It's a suspended expense. So the expense would be a deduction. It would be part of your income statement. Your income, so you start with your beginning retained earnings, right?
Okay.
Then you would add your income for the year. Well, the charity would be in that as an expense.
In that current year's.
Yeah, in the current year's income.
Even though you don't really get, I mean, you're not qualified to take it, you can still report it in that.
No, you don't count it as an expense. It's a carryover.
Okay.
It doesn't affect your retained earnings.
I guess it doesn't, because it's a carryover item, right?
Yeah, now would it affect you? It would affect your book income versus your taxable income, because you'd take it off as book income.
Mm-hmm.
It doesn't matter if I took more than 10%. I'd take it off my book income. But then it would be an adjustment.
Yeah.
It's one of those adjustments before I get to taxable income. You got with me on this? Okay, so excess over tax, no carryback allowed. Current year contributions are deducted first in, first out. And we've already said all this. Charitable contribution carryover cannot be deducted to the extent it increases an NOL. So if you had a loss, you couldn't have any carryover, even if you didn't have any charity. Other corporate deductions. This stuff you've kind of gone over. Gifts, how much can you write off? $25. It's been there forever. Okay, and there's that little thing about pens costing $4 and imprinted your name and all that stuff. Compensation, accrued compensation, you have 2.5 months. That's different than giving money to charity where you have till the tax return. So, if I have accrued compensation, I'm on the accrual basis, not cash basis. I have compensation. I give them a bonus. I gotta pay that within 2.5 months. So that's January, February, by March 15th. Or what happens? I don't get to write it off. If I gave them the money, I still gave them the money, but I don't get to write it off. I can write it off the next year. Okay? The same token, somewhere in here, we're getting ready to have our old favorite. I'm on an accrual basis, and I have a bunch of expenses that I have not paid my brother. You guys, we got over this so many times. I hope you got it. So here's the end of the year. I'm an accrual. He's cash. I owe him $4,000. I've already gotten whatever I bought from him for $4,000, but I didn't pay him until this year. So in this year, that $4,000 is taxable income to the cash guy, right? But if you're related parties, I can't write my accrual basis off until the year he writes his. So even though that under accrual, it would be an expense here, it's not until here. We've had this and we had it in part 1 too. But they're going to get it in part 2. There's a lot of stuff that they're putting in both of these because they apply. They apply a little differently sometimes. Unreasonable compensation, what is it? In reasonable compensation, you have to take it not as compensation, but as a dividend. Why is that important? Compensation is an expense. So the company gets to write off compensation as an expense. A dividend is not an expense, and the company can't write it off. So we have two companies, they both make $100,000. And one of them, we give this guy a salary of $80,000. What does he do for that $80,000? He parks cars. Only on Saturday nights. He's the son of the owner. So he says, I get $80,000. So now the profit is down to $20,000. The owner owns 100% of this, because if he only owns 50 or 60, the other guys involved would be going, no deal. Unless his wife was the other one. So they go, the IRS comes back and go, nope, that's unreasonable. It's not an expense, it's a dividend. A dividend doesn't change, it's not an expense. So when they go to retained earnings, we're going to say there was $30,000. They now have $100,000 of income. So the retained earnings is $130 minus the $80,000 of dividend. Your ending is $50, and they pay tax on $100,000 instead of $20,000. Everybody good? That's called cheating. Okay. A publicly held corporation, this is new, I believe, cannot deduct compensation in excess of $1 million paid in any tax year to a covered employee. Who is a covered employee, you might ask? If you look down here on number 1, you're going to see it. Okay? The principal executive officer, principal financial officer, and any of the 3 highest officers. What happens if you have what's called a parachute payment? You've got a deal with the company. If they sell more than 50% to somebody I don't like, I get all kind of goodies to leave the company. There's a bunch of guys that have those kind of things. Those parachute payments are not tax deductible. But that, the guy that gets them, it's good to be rich. But both of you know what a parachute payment is? You have a president of a company. He's got a deal. I'm running this company the way I want to. If you, the owner, sell your 50% of the company, and somebody, let's say you sell it to Donald Trump's brother or his son, and for me, that would be a deal breaker. Especially when I called his dad a fat line bozo. Probably wouldn't work well after that. Okay, so then I've got some go, no, I've been working all this and I've built this company up, and if I have to leave it because of something you're doing like that, you're selling it to my worst enemy, let's say, then I get a giant payout. You guys give me a bonus of $10 million for me to walk away from the company.
That's already written?
Yep, it's already written out in a contract. But that's not a tax deductible. That's called they used to call them golden parachutes.
Where is that at here? What is it called now?
That's number B. It's called the amount of a parachute payment made to an officer, shareholder, a highly compensated person is deductible. Oh, no amount. Had me worried for a second. All right. Okay, stock, the fair market value of property received for services is what? We've already said gross income. If they give you that stock at less than fair market value, I worked for 3 months. I made